Hello everyone, thank you for attending this course. Today we will continue our journey of investigating socially responsible investing strategies and introduce the third strategy, shareholder engagement. Following active screening and ESG integration, shareholder engagement has been the third most popular sustainable investing strategy in the past 5 years. And now let's move on to the agenda. So this chapter has been divided into three parts. As usual, I will start by introducing the definition of shareholder engagement and explaining some common terminologies in practice, and then I will briefly show the current market situation, and finally I will analyze a crucial quantitative paper dedicated to this topic and published in a highly ranked journal. So, shareholder engagement is one of the most important measures in active ownership. So, active ownership is the use of the rights and position of ownership to influence the activities or behavior of invested companies. Active ownership can be applied differently in each asset class. For listed equities, it includes shareholder engagement, voting activities, and dialogues with management. And also, dialogue with management can be considered as one of the engagement activities also. Shareholder engagement captures any interactions between the investor and current or potential invested companies on ESG issues and relevant strategies, with the goal of improving ESG practices or improving ESG disclosure. It involves a structured process that includes continuously monitoring company. These interactions might be conducted individually or jointly with other investors. Engagement include groups of investors working together with or without the involvement of formal investor network or other membership organization are basically called collaborative engagements. Voting, on the other hand, refers to the exercise of voting rights on management and shareholder resolutions to formally express approval or disapproval on relevant matters. In practice, this includes taking responsibility for the way votes are casted on topics raised by management, as well as submitting resolutions as a shareholder for other shareholders to vote on. And voting can also be done in person during a general assembly or by proxy. So proxy voting means fewer investors attend shareholder meetings in person, which means that most of votes are cast as a proxy vote, online, by phone, or by email. So in Switzerland, ASOS offers a service of detailed proxy voting report for every general meeting with voting recommendations for each items on the agenda. So you can check their homepage and checking each company's general meeting, the summary of their general meeting. Here is a short video explaining stakeholder engagement. So this is different from shareholder engagement. You can watch the video later by yourself, but in summary, stakeholder engagement brings shareholder engagement to the next level. It requires interactions with not only shareholders, but also those people, organization, community, or environment impacted by the company. The following table summarizes the benefits brought by utilizing active ownership strategies. From the communicative perspective, active ownership helps both investors and corporations clarify expectations regarding ESG matters, reduce asymmetric information, and enhance accountability. In terms of the learning aspects, main benefits concentrate on gaining new knowledge and grasping new trends in ESG theory and practice. And finally, we have the political aspects. Here we have benefits such as advancing internal collaboration and expertise regarding ESG and attracting long-term loyal investors. According to Figure 1, as of 2020, shareholder engagement representing over 4,007 billion assets under management is the second most popular sustainable investing strategy in Europe. From 2016 to 2020, the total assets under management grew by 25%, and the growth rate is mild but very steady. The second part of this lecture consists of a detailed analysis of one research paper and the selected paper named Shareholder Engagement on Environmental, Social, and Governance Performance. Is written by Thomas Barco and colleagues who utilize a proprietary database to study the various characteristics of activist engagement activities. So to study the behind-the-scene investor activism promoting environmental, social, and governance in improvements by means of proprietary database of large international socially responsible activist funds. The paper examines activists' target selection, forms of engagement, impact on ESG performance, drivers of success, and effects on the target's operation and value creation. So the engagement data came from a large European asset manager who, with more than 25 billion in total net assets under management, and activist manager manages funds across Europe, Northern America, and Asia, and has long focus on ESG specific investments. And in total, the database has 847 completed engagement sequences involving 660 different companies. At the initiation of an engagement, the activists formulates a clearly defined objective, and the author first partition the engagement cases into two groups based on the engagement's objectives, distinguishing between those aimed at changing the operations of the firm, for example, implementing new environmental technology for better water management, or reorganization-oriented engagement. This is also called reorganization-oriented engagement. And the second is providing more information on specific ESG dimension, for instance, better reporting standards such as publication of detailed sustainability report, which can also be called transparency or enhanced transparency engagement. And each of these engagement categories can be further partitioned according to which of the E, S, and G dimensions is the main dimension of interest. And also the sample can be further split based on whether the engaged firm is initially open to the activist demand or resist the activist demand, and whether the engagement outcome is success or failure. In terms of the company level data, accounting and stock return data from data stream, ESG performance indicators from SS4, and analyst coverage data from IBES database, and ownership data from Morningstar and Orbis. The method applied by the authors is simple and straightforward. They first perform the matching strategy to pair each engaged firm with 3 control firms. In this way, they can compare the treatment group with the control group by a difference in difference design to investigate which characteristics contribute engagement success. To examine the determinants of the activist decision, the authors first consider the characteristics of target companies in the year preceding the engagement relative to a matched sample, and the matching pool is the entire universe of companies in the Thomson Reuters SS4 ESG database. And they first exclude all engaged firms that are also part of the asset4 database to avoid potential overlapping issue between the treatment group and the control group. And then they restrict the pool to industries based on the 49 pharma French industry group. This is for the convenience of further analysis involving pharma French methods. And the most important step is to calculate the Mahalanobis distance matrix for each possible engaged and matching company combination based on size, market book ratio, ESG score, and return on equity in the year prior to the engagement. So the distance metric is the foundation of the matching strategy. There are many established matching metrics, such as propensity score matching. You need to make a choice based on your model design and assumptions. Finally, the author picked the three companies with the lowest distance metrics from the engaged company as a control. The lower the distance metric, the higher the similarity between the treated and the control group. And last but not least, they create a pseudo company for each engaged company using the equally weighted mean of the three matched company. And this pseudo firm's return will be used in the following comparison with the traded group. So to analyze the likelihood of being engaged, the authors conducted a linear probability regression on the probability of targeting related to a matched sample, where the dependent variable is 1 if a company is targeted and 0 is otherwise. And the same method has been applied to check the likelihood of being success. In this case, dependent variable equals 1 if the engagement is successful and 0 otherwise. To analyze the performance after engagement, the author applied the differences in differences method in which the dependent variable are market-based measures of performance like Tobin's Q, accounting-based measures of performance like return on equity, operating expenses, and also ESG performance like ESG ratings, environmental social governance scores, corporate, and finally changing capital structure like equity and debt issuance, and visibility is represented by analysts following. So these are the dependent variable. So in the equation, post POST is an indicator variable that equals 1 for the first year period following the success closure of a case and 0 otherwise. And also apply the same methodology on various subsamples, reorganization-oriented engagement, the quantile of firm with the lowest and highest score, and the environmental, social, and governance-oriented cases. So they replicate this difference in difference design in many different subsamples. And finally, the results. The results illustrate some interesting patterns. For instance, coefficient of sales markets share has a large value and is highly significant, indicating that the activists target visible firms with large market share. And the significant negative coefficient of ESG score variable means that activists do concentrate on firms in the poorest ESG performance category. And there are many other interesting facts. Please check the table and read through the author's description. And the analyst of success table follows the same logic. The overall result is as following. A reorganization requires less likely to be successful, and that previous successful engagements matter for the subset of engagement relative to environmental issue, but not for social and governance engagement. And finally, we have the difference in difference table. Panel A on slide 18 focuses on success versus no success. And the coefficients on the ESG performance ratings confirm that successful engagements leads to higher ESG scores. for the targets with X and weakest ESG ratings. Meanwhile, successful engagement improves sales growth. Again, there are many other interesting results. Please read the table carefully by yourself. And panel B on page 19 shows the results for engaged versus control group. The author finds that the engagement in itself has little impact on the ex-post accounting performance or any other firm characteristic. And for example, the increases in sales growth that we document for successful cases do not occur for unsuccessful cases. To sum up, the engagement from the activist investor seems most beneficial, and both in terms of ESG performance and financial performs with X and low ESG performance, suggesting that these ethical investors play an important role in helping firms understanding how they can improve outcome from all their stakeholders. And there are also some important findings, such as activists generally targets large firms with large market shares. When a hard engagement occurs, the likelihood of success for completion is low. And more intensive contact between the activist and the target does yield success more frequently. And on average, accounting performance measures and their components do not significantly improve or change their after engagement. So that's the end of this chapter. Thank you so much for your attention and see you next time.